What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. I hope you're doing well. Today, we're talking about mortgage rates. Mortgage rates have hit a 23-year high recently, and they're currently floating around the mid 7% range, depending on where your credit score is and what part of the country you live in. But overall, mortgage rates are very high. So, I wanted to talk about when our rates going to come down. What can we expect in the future? Are rates going to hit 10%? Now, I was talking with a realtor the other day, and he was saying that his son is a financial analyst, and he said, "Hey, my son says that mortgage rates are going to hit 10% by April." And I personally don't buy it, and I'm going to go over my reasoning in this video here. So be careful who you listen to. Take this all with a grain of salt. Use these links to your advantage and use them to help you make your own decision about where you think rates are going. But to me, based on the information that I look at, it seems like rates are near the top of where they're going to be. And let me get into my reasoning. So we're going to switch over to Google Chrome here. Nefq, the local Vermont firm that we use frequently for our buyers. Actually, I just did a closing with Nefq today. They show their rates online. So here in Vermont, best 30-year fixed rate mortgage, 7.25%. And that's about the best rate around. So rates are very high, up over 7% again. We made videos this summer of rates up in the 7.5% range. Things like that. So we're still not at the peak of where things were. They were even at 7.5% last year, but still they're higher than the 6% range than where they were earlier this year. So moving over to this article from Yahoo, mortgage rates hit 23-year high. We're going to scroll down to this chart, which is really what I wanted to point out in this article, and it shows where mortgage rates were or where mortgage rates are relative to their historical preference, their historical value. So when we look at historically speaking, mortgage rates actually aren't all that high. We see back in 2004 through 2007-ish, they were sitting at around 6%, 5%, and then even before that, leading up to 2000, mortgage rates were up above 8%. So after 2008, mortgage rates came down quite a bit and they stayed below 5% for the majority of the decade leading up to the pandemic and where we are now. But historically speaking, rates aren't that high, which is something I've discussed in my other videos where, prices are high relative to historical data, but rates are actually pretty stable. Even though they feel high right now, rates are pretty stable. Part of the reason why they feel high is because we've had a manipulated mortgage market over the past decade or so. So I wanted to go into why rates are high. And if you saw the most recent Fed rate hike, as we're talking about now in this next article, the Fed keeps rates steady, toughens policy stance as soft landing hopes grow. So this is why rates started to rise. This is why mortgage rates started to rise. Basically, what people interpreted based on the Federal Reserve speech is that, hey, they're doing rates higher for longer. So they're not cutting rates. They're taking a hawkish stance, and they're going to keep rates higher for longer, which in turn impacts the bond market, and then the bond market comes back and impacts the mortgage market and the housing market. But when we dig deep into what the Federal Reserve is saying, to me, it doesn't actually seem all that hawkish. And of course, hawkish means tighter rates, higher mortgage rates, slower housing market. Dovish means lower rates, more stimulus into the economy. But when we take a look at where the Federal Reserve, and what this chart is showing is where the Federal Reserve, the members of the FOMC, the Federal Open Market Committee, are expecting their Fed funds rate to be moving into the upcoming years. So we see most people assume that at the end of 2023, the FOMC thinks that rates are going to be where they are now, in between that 5.25 to 5.5% rate. As we move into 2024, most of the FOMC members expect the Fed funds rate to be down at around 5%, maybe even below. So the expectation is that they're going to cut rates next year, which I think will in turn bring mortgage rates down. And then in 2025, it's kind of all over the map, but you can still see that the majority of the FOMC participants are expecting rates to be at around 4% or maybe even a little bit below 4%. So although they had a hawkish sentiment with their Fed speech on September 20th, what they are predicting is that they're predicting to lower rates over the upcoming years. And, I think personally, the bond markets are showing that rates are going to lower it maybe even faster than what they're predicting, which I think would bring mortgage rates down. And that's why I think we're at the peak. I don't really see, in this data where rates are going to hit 10%. Now, in the Yahoo article, they reference a expert who says that rates could hit 8%, and that's something that I could see because of the variability in the U.S. Treasuries. So if we think about how the mortgage market works, we have our U.S. Treasuries, the 10-year Treasury, where people say that this is what the mortgage market most closely trades off of. So when Treasury yields rise, mortgage rates rise. And what we've experienced over the past month or so is we've experienced a rise in the 10-year Treasury, right? The interest rate, the yield on the 10-year Treasury has gone up significantly, specifically here in September, which is what this data is showing that I'm highlighting now. That's the increase that's happened since September, which has caused mortgage rates to continue to go up. So why are 10-year Treasuries rising? And then from there, why does that affect mortgage rates? So I've been doing some research and trying to look. I have another Reuters article here trying to figure out why 10-year Treasury rates are rising, and I haven't been able to find anything that I really like as a firm expectation or as a firm reason. A lot of these bond speculators, what they're saying is that the housing market, that people aren't certain with what the Fed's going to do. Is the Fed going to, keep rates higher for longer, which would make things less liquid for them? The liquidity in the bond market would be lower because if they were to sell their bonds off, which the bond market is generally a very liquid market, you can find a buyer out there, but you might have to sell it at a lower price so that buyer gets a higher yield. So they'd have less immediate liquidity if the Federal Reserve keeps rates higher for longer. But if the Federal Reserve lowers their rates and bond prices go up, then the price of their bond goes up because the yield is lower, right? If you have a $100 bond, for example, and you buy it at a 4% yield, that yield goes up. In order for somebody to get your same bond at a 10% yield, you need to sell it to them at a lower price. And inversely, if you buy that 4% bond and the price goes down, the bond yield market price goes down, then you can sell that $100 bond for maybe $110 because the investor doesn't need to get as high of a yield as you got with your bond. So that's kind of what's going on in the bond market. And that's what they said here in this article. But at the end of the day, why bond prices are rising, I think this is really the best explanation that I've found, and it seems to be true with all markets, right? There's buyers and sellers, and when we're talking about the bond market in particular, I think this quote sums up, from a basic standpoint, why bond prices have risen. It just looks as if finding enough buyers for all treasuries is requiring a price discovery process that is painful, he said. I'm not sure who this is. Kit Jux, it looks like, global head of currency strategy at Societe Generale. So I think that's what's going on in the bond market, and we could see the bond market continue to rise as there's less buyers out there. There's less people that want to risk having less liquidity in the future, less corporations primarily and other institutions, maybe pension funds, things like that, want to risk having less liquidity than they have right now. And so I think that could cause the 10-year Treasury to rise, which could cause mortgage rates to rise, maybe another percent. But I don't think the Federal Reserve is going to hike rates and cause mortgage rates to rise based on their Fed funds rate. And the reason why we talk about the bond market, and this is the last point I'm going to make here, just to sum everything up and bring it all together, the reason why the bond market relates to the mortgage market is because it's investors who are dictating the price of these mortgages, of these bonds. So in a previous video recently that I made, I made the argument that I think buyers are the people who dictate the price in the housing market. I think it's the same in the bond market. It's the buyers who dictate the price. So when the Federal Reserve raises their Fed funds rate, most of these buyers out there, these banks, these institutions who would buy treasuries or would buy mortgage-backed securities, can now get a risk-free 5.5% rate from the Fed. So in order for them to purchase US Treasuries, the theory is that they would need a better rate than 5.5%. Of course, that's not what we see in practice because the US mortgage rate or the US 10-year Treasury is sitting at around 4%. But it has increased significantly over the past few years because they can get that risk-free return at the Federal Reserve. Now, these same investors are the people who are purchasing mortgages. And so there's not a lot of mortgages being issued right now. And the few that are being issued, the people who are out there who want to invest in them are requiring a higher interest rate than these treasuries are offering. They're requiring a steep premium at around 7% for the risk that they're taking when purchasing these treasuries, or when purchasing these mortgage-backed securities. So that's how bonds, the Federal Reserve, and mortgage-backed securities are all related, and how that plays into the price differential. Now, I've speculated in some videos in the past that if we see a flood of transactions come to the market, we could see mortgage rates go even higher. And so that, I guess, is another possibility. If we see a flood of sellers come to the market and these buyers flush in, and all of a sudden we have a ton of mortgage-backed securities being issued, these investors who are buying these mortgage-backed securities could demand a higher return on investment for the risk that they're taking, depending on the market condition, which could cause rates to go higher. Again, I don't think any of these forces are going to be enough to push it up to 10%. But is 8% possible? Sure, it's definitely possible. We're not far off, but I do think rates are going to start coming down over the next year in 2024 as the Federal Reserve cuts rates and the market becomes more sure of what the Fed's policy moving forward is going to be. So let me know what you guys think. Leave me a comment. Do you think I'm right with my predictions? Do you think I'm wrong? Read the information below. There's some very good articles there. If you're looking to buy or sell a home anywhere across the country, let me know. All my contact information is in the description. I'd be happy to help you. Other than that, I hope you guys enjoyed the video, and I'll see you in the next one.